Ever wondered how to reduce risk in your investment portfolio? Diversification is the key. This fundamental principle of risk management encourages you to spread your investments across various assets. Imagine your investments as eggs and your portfolio as a basket. By avoiding placing all your eggs into a single basket, you ensure that any underperformance of a particular asset does not significantly impact the overall value of your investments. Diversification is more than just precisely distributing your wealth. It's about strategically allotting your investments across different asset classes such as stocks, bonds, and real estate. Each type of asset performs differently under varying market conditions. For instance, when stocks are struggling, bonds may prosper, and vice versa. Therefore, by having a diversified investment portfolio, the negative impact of one asset's poor performance could potentially be offset by the good performance of another. However, it's important to note that diversification is not a foolproof strategy against loss. It is merely a tactic to manage and mitigate potential risks associated with investing. It doesn't promise profitability, but aims to reduce the volatility of your investment portfolio and increase the potential for better returns. The objective of diversification is to achieve an optimal balance between risk and return by capitalizing on the varied responses of different assets to changing market situations. Its approach to investment that requires careful planning, diligent monitoring, and periodic adjustment based on market trends and personal financial goals. It's crucial to remember that diversification is not a guaranteed shield against loss, but a strategic approach to manage potential risks. The goal of diversification is to strike a balance between risk and return, as different assets may respond differently to market conditions. Asset allocation is a frequent diversification strategy. This means that it involves creating a portfolio structure using a variety of asset classes. The idea is to spread your investments across multiple avenues instead of putting all your eggs in one basket. The asset classes that an investor chooses to include in his or her portfolio by several factors. These elements can encompass an individual's appetite for risk, their financial aspirations, and even their investment timeline. For instance, a young investor with a high risk tolerance might for more volatile asset classes like stocks, while an older investor might prefer safer investments like bonds. It is crucial to remember here that diversification does not guarantee a profit. Investing always carries an inherent level of risk. However, regular reviews and adjustments of your portfolio can help manage these risks. This step allows you to maintain the asset allocation that you initially decide upon. Therefore, periodic review and adjustment of your portfolio is crucial to maintain the decided asset. Diversification can be achieved not only across various asset classes, but also within the same asset class. The fundamental principle of diversification is to spread out your investments, thereby reducing potential losses and enhancing growth. Imagine it as not putting all your eggs in one basket. Let's take stocks, for example. If you were to invest all your resources into a single company's stock, the risk would be tremendous. Suppose that company fails, your entire investment would be at risk. Now, consider the alternative: spreading your investments across different sectors or companies within the same asset class. This approach is referred to as intra-asset diversification. It is a strategic investment approach used to protect your portfolio from potential downturns in specific sectors. By spreading your money across various industries, you create insulation for your portfolio against industry-specific downturns. Intra-asset diversification doesn't just limit itself to different industries within the same asset class, but it also extends to different geographical regions. So instead of investing in companies from just one region, you invest in companies from various parts of the world. This geographic spread further cushions your portfolio from potential downturns in any particular region. By diversifying, you can temper risk and enhance stability. This approach can further reduce the effect of a downturn in a specific sector or region on your overall investments. Investors often contemplate diversifying across various investment styles. This could encompass a blend of diverse stocks, including growth and value stocks, or a mix of large cap and small cap stocks. The rationale behind this approach is that each investment style has a unique response to market shifts. This variation in reactions is vital in addressing and dealing with fluctuating market scenarios. By diversifying across investment styles, investors can effectively manage and significantly reduce investment-related risks. It's like putting eggs in different baskets, where each basket represents a different style of investment. The unique characteristics of each style provide a sense of balance, ensuring that a decline in one style doesn't necessarily cause a downfall in the entire investment portfolio. Moreover, this diversification strategy is not just beneficial in mitigating risks, but also offers the potential for higher returns, as each investment style has its own growth trajectory. Therefore, it is not just about reducing risk, but also about enhancing potential returns. It's interesting to note that each style's unique response to market fluctuations forms the bedrock of the risk mitigation strategy. This is because each investment style reacts differently to market conditions, contributing to the overall risk mitigation strategy. Understanding that while diversification is a popular strategy, it doesn't eradicate all risk is crucial. Diversification may help mitigate some risks, but it isn't a bulletproof defense against financial uncertainty. The global market is a volatile and unpredictable entity influenced by a plethora of factors. These range from political incidents, technological advancements, to natural disasters and more. Each of these factors can trigger fluctuations across various sectors simultaneously, affecting your investment portfolio. This necessitates a constant review of your financial objectives, leading to strategical realignments of your diversification plan. Only through continual introspection and modification of your strategy can you safeguard against these potential disruptions. With the ever-changing landscape of the global economy, your approach towards diversification should be fluid and adaptable. Regular reassessment and adjustment of your diversification strategy is vital for enduring. Diversification can also incorporate different investment vehicles. It allows you not to confine yourself only to stocks and bonds. Have you ever pondered what else investment world has to offer? Have you probed into multifaceted investments like the real estate market or the commodities sector? In this vast financial ocean, have you taken a deep dive into the uncharted waters of cryptocurrencies? These are not your run-of-the-mill assets. They are classified as alternate assets, supplementing the conventional sources of returns on your investments. These assets, contrary to the norm, don't follow the pattern of conventional investments. They, in fact, beat to their own drum, creating a financial rhythm that is distinct yet harmonious. They often bring a unique melody to your investment portfolio, providing a rich and varied financial symphony. These alternative assets can provide additional sources of returns and may not always move in sync with more conventional investments. Diversification in terms of time horizon is crucial. Strategies involving time-based diversification break your financial portfolio into two main classes: short-term and long-term investments. Each class holds its unique significance and benefits. The short-term class provides liquidity, satisfying immediate financial needs or emergencies. On the flip side, long-term investments, often riskier, hold the potential for substantial returns over extended periods. These two categories working in harmony can optimize your asset allocation, ensuring your portfolio remains well-balanced and resilient in fluctuating market conditions. The short-term investments provide the financial cushion, while long-term assets continue to grow and compound. This division of assets aligns with your financial goals, ensuring an effective hedge against unexpected market shifts. Allocating assets based on short-term and long-term goals can help ensure that you have liquidity for immediate needs, while allowing other investments to potentially grow over a more extended period. In conclusion, successful diversification requires careful and deliberate planning, supplemented by an in-depth understanding of risk tolerance, financial objectives, and the ever-changing market conditions. It's not merely a strategy, but it's an art that needs to be fine-tuned to blend harmoniously with your particular financial landscape and your long-term goals. Diversification is about more than just dispersing your wealth into various asset classes or industries. It's about aligning and attuning your investments with the unique intricacies of your risk capacity, your financial dreams, and the myriad market dynamics. It's about understanding that your assets aren't just numbers on a screen, but vessels that carry your hopes, dreams, and aspirations towards the future you envision. Moreover, the importance of a regular check on your investment portfolio cannot be overstated. It's a must to ensure a balanced and diversified investment strategy that sails smoothly through the ebbs and flows of the financial market. Changes, modifications, and adaptations are necessary, not merely to survive, but to thrive amidst the constantly shifting sands of market conditions. When it comes to investment strategies, one should remember that it's not a one-size-fits-all approach. Each investor is unique with different risk tolerance, financial objectives, and expectations from the market. Therefore, a personalized approach is essential. The key is to tailor an investment strategy that not only manages risk, but also aligns with your financial goals and market expectations effectively. In the end, if you're exploring ways to mitigate risk in your investment portfolio, diversification with its vast array of facets could be a strategy worth considering.